Hey everyone, welcome back to Corporate Decoder, the place where we unravel the truth behind company reports. And today we have a real gem, a deep dive into VSE Corporation's annual report for 2025. And let me tell you, there are some interesting moves being made here. Get ready, because this report is packed with strategic shifts and significant financial maneuvers to keep track of all this info. And for more exclusive content, join our Discord community, linked in the description below. So VSE Corporation, they're a big player in the aftermarket for aviation parts and services. Think maintenance, repair, and overhaul for airplanes and all their bits and pieces. Before we get too deep, let's look at the top line numbers. A quick glance at their financials reveals some pretty exciting growth. For the big picture, 2025 was a record year with revenues hitting a cool $1.1 billion. That is a massive 41% jump from the previous year. Imagine that, a 41% revenue increase. That means they're selling way more parts and fixing way more things. They attribute this to new acquisitions and winning new contracts. Sounds like a solid strategy. They are really pushing into the aviation aftermarket, looking for those higher growth and higher profit areas. Now, when revenues go up, costs and operating expenses usually follow suit, and in 2025 they saw a 41% increase in these costs, two pretty much in line with that revenue growth. But here is where things get a little nuanced. They also had significant charges this year and intangible asset amortization that jumped up quite a bit due to those acquisitions, and a nearly $30 million charge related to the fair value of an earn-out receivable, which sounds like a complicated way of saying they had to adjust the estimated value of a future payment connected to a past deal. So with all that revenue growth and those extra charges, operating income still managed to climb by a healthy 52%, reaching almost $90 million. That is pretty good considering all the moving parts. But the real story here is the management's discussion and analysis mentioning they completely replaced their previous credit agreement in May 2025. A new credit agreement that provides greater flexibility and increased borrowing capacity. It seems like they are positioning themselves for even more growth and acquisitions, possibly to fund future ventures. Let's talk cash flow for a moment. In 2025, they brought in about $27 million from operations, which is a huge improvement compared to the negative $31 million. They used in 2024 last year was tough on cash flow from operations, but this year they've turned it around significantly, likely due to that improved profitability and better management of their working capital. Investing in the future is definitely on their minds, as they used a significant amount of cash in investing activities, over $276 million in 2025 compared to about $263 million in 2024. This increase mainly reflects more money spent on acquisitions in 2025. Which is a key part of their growth strategy, but they also got a nice chunk of cash back, about $138 million from selling off business segments that don't fit their new focus. Financing activities provided a good amount of cash, over $289 million in 2025, though a bit less than the $315 million in 2024. This difference is mostly due to some big repayments of debt they made, which is a good sign of financial discipline. Looking at their assets, property and equipment grew by about $20 million year over year, reaching over $91 million in 2025. This means they are investing in their physical infrastructure, likely to support the increased business from those acquisitions. And then there is goodwill and intangible assets, which have significantly increased due to those same acquisitions. These now represent a substantial portion of their total assets, a common sign for companies focused on growing through buying other businesses. Speaking of acquisitions and goodwill, let us scroll to that goodwill number. Goodwill represents the premium paid over the fair value of acquired assets. A massive increase in goodwill from $428 million in 2024 to over $641 million in 2025 clearly shows they've been busy buying companies and paying a premium for them, and importantly for 2025, there were no impairments of goodwill, which is a great sign that the acquired businesses are performing as expected. Their intangible assets also saw a big jump from $197 million in 2024 to $295 million in 2025. This reflects things like customer relationships and brand value that come with those acquisitions. They are also amortizing these assets over their expected useful lives, which is standard accounting practice. On the debt side of things, they're long. Term debt decreased quite a bit from $430 million in 2024 to $292 million in 2025. They paid down a lot of their debt, especially from the revolving facility, using proceeds from selling off segments, and from a big stock offering in October 2025 that brought in over $441 million net cash. This strategy of selling non Core assets and raising cash through stock offerings is a strong indicator of repositioning and preparing for major future moves. And what do you know, just a few months after this report was filed in February 2026, they initiated even more offerings of common stock, and these interesting things called tangible equity units. A really clever way to raise capital, and they raised about $1.3 billion from these offerings to fund an even bigger acquisition. This is where things get really exciting. Now, this is the big news they announced in January 2026, the acquisition of Precision Aviation Group, or PAG, for a hefty $2.025 billion. This is a huge deal for VS. And really reshapes the company. PAG is a major player in the aviation aftermarket too, so this acquisition is all about consolidating their position and expanding their reach. Even further, this deal is expected to close in the second quarter of 2026, and they are financing a good chunk of it with the money they just raised. But it is not all smooth sailing, of course. Every company has its risks, and VSE's report highlights several key ones. Operational risks related to the aviation aftermarket itself. A tricky customer concentration is a notable concern, with a group of affiliated customers accounting for around 20% of their revenue in 2025. Meaning if those customers have a bad year, VSE feels it directly. And then there are the risks associated with those acquisitions. We talked about integrating new companies is complex and can cause diversions of management attention. In today's world, cybersecurity is a big one, and VSE acknowledges the risks they face from cyber threats and security incidents. They mention they have processes in place and work with third-party partners to manage these threats, but it is an ongoing challenge for all companies. They also operate in a heavily regulated industry with the FAA and similar agencies around the world. Overseeing their every move compliance with these regulations is critical, and changes could impact their business. Their debt levels, while managed, are also a point to consider, and market volatility can always affect their ability to access funding at the end of the day. VSE Corporation had a very strong 2025. Marked by record revenues, significant strategic acquisitions, and a successful repositioning towards a pure aviation focus. They sold off the parts of the business that did not fit their new vision, and used that cash to invest heavily in growth. The PAG acquisition is a game changer that will make them a much larger entity in the aviation aftermarket. However, this growth comes with significant financial integration and operational risks associated with managing such large and complex transactions. Their direction seems clear: aggressive growth through acquisition, and a narrowing of focus on aviation services. The key will be how well they integrate PAG and manage the increased debt load and operational complexities, while the financials show impressive top-line growth and improved profitability. The sheer scale of the PAG deal and the associated financing means they are entering a new phase that will test their execution capabilities overall. VSE is making bold moves to become a dominant force in the aviation aftermarket. If they can successfully integrate PAG and manage the associated risks, this could be a very rewarding investment for shareholders. But as always with such aggressive growth strategies, there is a considerable amount of execution risk involved. Alright, that is our breakdown of VSE Corporation's latest filing. What do you think about their aggressive acquisition strategy and the PAG deal? Are they setting themselves up for success or taking on too much risk? Let me know your thoughts in the comments below. If you found this deep dive valuable, make sure to smash that like button and subscribe for more corporate insights like this. And hey, if you want to stay ahead of the curve and get access to exclusive content, join our Discord community. The link is in the description. Thanks for watching. See you next time on Corporate Decoder.